What if I tell you that there is a much better way that has a higher win rate to trade fair value gaps? Those specific fair value gaps are high probability, and you can create a full trading plan based on them, as well as it can work on any time frame. If anyone needs one-on-one mentorship, check out the description. And now let me show you those high win rate fair value gaps. Now, before we start, a prerequisite to this video is my videos about high probability fair value gaps. Make sure to watch that video, because in this video, I'll be only focusing on one aspect of the high probability fair value gaps. There would be specific fair value gaps that we focus on. But in general, when we are looking for high probability fair value gaps, you gotta watch my other video. Now, considering this price action right here, this is euro dollar on the 15-minute, and we are in a weekly bullish fair value gap. So this is a bullish weekly fair value gap. We're coming here, we're waiting for a displacement or any type of entry to go up from here. As we said, the creation of a fair value gap tell you a story. So looking at this, what do we have here? We have a sweep that is followed by displacement. No fair value gap created here except this one, and you guys know that we don't take bullish fair value gaps at the extreme top. It's not worth it. And we can see that we have a fair value gap here that is pushing price lower. Now, let me show you this. We have this bullish fair value gap with the displacement. So a big candle, bullish fair value gap. If we mark this from here to here, that's our bullish fair value gap. We can see that on this time frame, it was not really respected that much, as there is a candle that it closes below, but it was actually mitigating the order block. So it was still respected somehow. Why? Because we know that price could go to the order block and then reverse. And you can see the reversal here. A lot of people would be entering here, and when they saw this candle closing below the fair value gap, they would close the trade. However, I don't want you to trade this fair value gap no more. This is not the fair value gap that you're going to trade from this day. If you really want to get a higher win rate, what are you going to do is, and this is how I improve my trading, instead of taking the high risk fair value gap that has, a very high risk and low win rate, I took another one that has a higher win rate. Which one? So if you can see, after price kind of respecting this, and we could disagree on this, but let's say we agree that this fair value gap is respected in your opinion, as price did respect the order block, just went deeper into the order block. And if we go to 30 minutes, for example, would be respected. After price respected this fair value gap, went up, what happened here? Create another fair value gap. What do we see from this fair value gap? This fair value gap was respected, and you could get a sniper entry here. So what you could have done is entry at the fair value gap. And why is this? Why is this a high probability one? Because it's the second fair value gap after price respecting the first one. And usually this would be after a 2022 mentorship model happening on a bullish PD array on the higher time frame. So this is a weekly fair value gap. Price respected that first one, created another one before price reaching the main drawn liquidity. Remember this, if price created a fair value gap, it was not triggered, and then price reached the main drawn liquidity, on this case, it's not a high probability no more if it reached the drawn liquidity. Why? Because price already reached the destination, so there's no point of entering again. Today's video is sponsored by Hanko Trade, one of the best brokers in the business, with spread as low as 0, low commission, and you can trade all markets, including forex, indices, and crypto. And if you use the link in the description, you will get an exclusive 100% bonus. Make sure not to miss it. Let's get back to the video. Now, in this case, stop loss below the last low, since this is a big one. And then what can we target? You just go, and I'm not going to go to the higher time frame, but you could simply see the trend line liquidity. So all of this is a low resistance liquidity. And what do we say about low resistance liquidity? There would be a low resistance liquidity run, which is equal to displacement. Price will go take all of those highs, which is now this high is the main drawn liquidity. It would take all of those stop losses above and orders above in the fastest time ever. Why? Because we have a lot of low resistance liquidity. We have liquidity, more liquidity, more liquidity, more liquidity, more liquidity, more liquidity, and it goes on and on. Because there is no high resistance liquidity run anywhere in here. I don't see nothing except maybe this one. But otherwise, all I see here is low resistance liquidity on the other side. Now, could have targeted this high, this high, this high, or simply take partials at those highs. And this is your main drawn liquidity. Now, as we said, we could disagree on this, that price did respect this fair value gap. However, what do we have next? So this is the first opportunity. I'm going to go drag it to the left. If we could agree that this is the first fair value gap that is respected here, did we create another fair value gap after? And if there is another breakout structure after price respecting the fair value gap, so if there is fair value gap respected, a breakout structure creating another fair value gap, and oh my god, if there is an old high or old low aligning with the fair value gap that created the breakout structure, that's even a higher probability one. So we could say that this is the first fair value gap that is respected. Price went up, broke a structure, and we could say, oh, this is my structure, or this one, both, but this is the one that is aligning with the fair value gap or overlapping with the fair value gap. Now, this is a high probability one. So this fair value gap is a high probability one. Why? Because first of all, it's the second fair value gap after price respecting the first one. Second, it's overlapping with an old high. So this is my entry, 50%, or the overlapping with the high. We enter here, stop loss below the low of the fair value gap right here, and we could target what? The same drawn liquidity somewhere in here. That's another entry. That is a high probability one. Now, this is a high probability one also. Why? Because it's the next one that is created after this one. However, did we come back to it to mitigate it before price reaching the main drawn liquidity? No. Then it's not high probability no more. So second fair value gap is the highest probability. If it's aligning or overlapping with an old PD array, that's even better now. All of this, we should not take the main drawn liquidity before price coming into the fair value gap. It should come first, then go to take the main drawn liquidity. If it took the main liquidity, then the fair value gap is not the highest probability. So we're going to go over NASDAQ, the daily time frame. Why? Because this chart itself from May 23 until current price action, it has a lot of examples of the fair value gap, the high probability one. So starting from this point, for example, what do we see here? This price action here, or this candle respected this fair value gap and then immediately reversed to the upside. So this fair value gap respected, price went up. Where is the first fair value gap that is created after price respecting the first fair value gap? It's this one, which means this is a high probability one. And what happened here? Price respected this a little bit, of weeks below the fair value gap, but overall the fair value gap was respected. Price went up. Now this fair value gap respected, and this is without looking at the drawn liquidity. We also have this fair value gap that is aligning with another PD array. Unfortunately, this one was not respected. Maybe some respect here, 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 and here. The upside on the lower time frame, you would be getting some profits. You should have some profits here too, but it's not going to be the same as this one and the same as this one. Now, price going up, right? Coming lower, price created a fair value gap here. What did we agree on? We do not enter on the first fair value gap if you want the highest probability one. What do we wait for? The second fair value gap. So the first fair value gap here is respected, and this is a bearish one. Respected here. Did we create a fair value gap after? Yes. This is a fair value gap here. So we have the fair value gap right here. We can see an immediate respect to this fair value gap going lower. And we can see going lower, we did not create fair value gaps except this one, this fair value gap. But this one, it just at the end of the range, we can see that we have more bullish fair value gaps. And if you are not aware of this, make sure to watch my other video. Now we can see this fair value gap we're going to ignore. We have this fair value gap, which is a bearish one. If you entered from here, it's going lower. Now, what do we have here? We can see a fair value gap created here. We ask ourselves question, did price got respected from a fair value gap? Yes, we had this fair value gap right here. This is a bullish one. So a bullish fair value gap pushed price up, created another fair value gap. What does that mean? This is a higher probability fair value gap that we can trust. And we can see that price respected this fair value gap going up, and price kept going up from here. Now, this is also the second fair value gap after price respected this fair value gap. So this could be a high probability one. But where did price react from? Actually, we had this liquidity level inducement, and we have this unfilled part of the fair value gap here. This is the unfilled part of the fair value gap. So we know that this is a high probability fair value gap. Why? First of all, price respected another fair value gap here, created this one. Another one is the inducement here. So this could be a high probability one. And you can see the 50% of the unfilled part of the fair value gap is respected here. Price went lower. What do we have here? Price respected this fair value gap. Did it create another fair value gap? Yes. It created this fair value gap. Was it respected? There you go. Very nice respect of the fair value gap going lower. And you can see, now you ask yourself this question, did price respect the fair value gap here? Yes. It did take this low into the fair value gap. Did it create a fair value gap here? Let's see on this price action. Fair value gap, I don't see nothing. There is this one, but this is just too high, and price went to this fair value gap and reacted. So it's not the highest probability. Why? Because the draw in liquidity is already hit, the nearest one. Now price went lower. We have price hitting a fair value gap. Did we create a fair value gap here? No, there was nothing. There was this fair value gap here actually, and this was respected too. Why? Because it's a fair value gap created after price respecting another fair value gap, but it's not the highest probability one. Why? Because it's not on premium. You can see on this dealing range from this high to this low. This is not on premium. If we grab our pip from this high to this low, this is not on premium. So it was not the highest probability one, though it worked and it was respected by another fair value gap. Price went lower. Now we ask ourselves, we can see that we have a fair value gap here. Was this fair value gap created after price respecting another fair value gap? And it looks like yes, we have a fair value gap here and filled part of it, respected here. Price went up, which means that this is now a high probability fair value gap. On this case, what is our draw in liquidity? The first one is here. The second one is this high, and it's taken already. So we're not going to be taking a look at this no more. It could be working, but it's not the highest probability one after price taking this. Otherwise, if price was here, came lower, taking the trade, targeting the strong liquidity and this one. So this is the case now. This is the case. As you guys saw, price respecting the first fair value gap, creating another one, that's a high probability one, especially after breaking structure. If you could see here, price did a market structure shift at this low, leaving a fair value gap. After respecting the first one, very high probability one. And even on the 1 minute, if you're really a 1 minute trader, you could see this here. So price did take a liquidity here, maybe another one to the left, but on the 1 minute, I cannot see it now. And what happened after? Did not create a fair value gap here, a very small fair value gap here, and another big one here. Now, if you could see, price did not create a bearish fair value gap after creating this all the way here. No bearish fair value gap, small ones only. But the extreme one, when price hit the extreme fair value gap, this one right here, and on kill zone, mitigation of the fair value gap, creating another fair value gap. What do we consider this fair value gap here? A high probability fair value gap. And you can see 50% exactly hit, stop loss above this high right here, and targeting what? The main drawn liquidity. You could have targeted, first of all, the fair value gap here, and then those lows, and maybe going lower and lower. So this is how you trade. Now, we go to the left. What do we see here? If you can see, we have this low in a fair value gap is taken right here, mitigation of a fair value gap. Then what do we say? Enter from this fair value gap. And this actually worked. You can see entry here at the 50%, stop loss below the low, this low, for example, this one, and then targeting what? The main drawn liquidity. I would say this one or this high. And this one worked. Now, if we did not say that this is a mitigation of a fair value gap, and we want to see a fair value gap created after price respecting this fair value gap, and this was our first fair value gap. Where did price create a fair value gap after? Price did come here, create a fair value gap. So now this is the second fair value gap after price respecting the first one, which is this one. What do we do here? Entering from here, stop loss below the low. And if you just put it below the low exactly, you might get stopped out, you might get unlucky, and you could have targeted the same one, same drawn liquidity, and that's another trade. So in both scenarios, you are winning. And you see this one, it's going lower, and you can see price respecting this fair value gap, creating another fair value gap, this one also respected, price going lower. And eventually it's going to go to the take profit. And as you guys see, few minutes in, we are here, and then immediately price went where? To the main drawn liquidity. It's going lower. So this fair value gap is a high probability one. This is where you should have entered exactly at the 50%. That's it for the video. Hopefully you guys learned something new today. Make sure to hit the like button, subscribe to the channel, share the videos with your friends, leave a comment, and I will see you in the next video.